The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is senior Chanticleer columnist at the AFR, Tony Boyd. Tony, how you going?
Very good, James, and great to once again bridge the divide between Sydney and Melbourne.
Brilliant. Well, this week we're going to examine the coronation of China's president and the implications of that for the rest of the world. We're going to explain why dirty coal has suddenly turned into gold for some investors, and we'll preview next week's federal budget. But Tony, I think it's only fitting that we start with the big international news of the day. England lost a magisterial Liz a few weeks ago, and now they've lost the prime ministerial Liz. Liz Truss is gone after just 45 days. It's almost hard to believe, Tony. It's a very British thing, isn't it, to lose a prime minister so quickly?
Yes, I think the FT editorial summed it up. 3 prime ministers in the space of 3 months.
Yeah.
Anyway, staggering, isn't it? I mean, I took away 3 big lessons from this. First, the Westminster system of government works.
Yeah.
It can get rid of duds reasonably quickly. Second, I reckon financial markets have just got such power to send a signal to a government about irrational economic behaviour. And also there was a wonderful sort of editorial in the Wall Street Journal about Andrew Bailey's role in her departure and the way he put an end date on his gilt-buying program, which really forced the Treasurer basically, or the Chancellor to resign because there was so much uncertainty hanging out there, put there by a Bank of England governor who'd earlier been criticised by Truss. And then my third lesson, I suppose, is that the regulation and structure of the UK pension market is just a complete disaster that needs to be looked at because it's a threat. Just managing liabilities is a threat to the financial system. I mean, what did you think? I love the lettuce anecdote, by the way, James. If you could explain that one.
Yes, the Daily Star in the UK, they put a webcam on a lettuce and they dressed the lettuce in a small blonde wig, and they asked the question, who's going to last longer, Liz Truss or the lettuce? And they did that 7 days ago, and of course the lettuce has won. So I don't know what that says about British politics or British newspapers, but it's a great creative idea. I'm with you, Tony. I think the big thing here is the bond vigilantes are back. You know, there's always been this idea that bond markets act as like the enforcers of the financial world. When they don't like something, they are quick to show the government that they don't like it by pushing up bond yields and making it harder for the government to borrow money and do the things they need to do. And that's exactly what's happened here. They hated Truss's policies around tax cuts and caps on energy prices. They pushed up British bonds, which are called gilts, and really they blew up the government. And now the next leader, whoever that might be, has to wonder how he or she is going to keep the bond market happy, because it's clear that that's what they're going to need to do for the next little while at least.
And really that defined benefit pension problem is not going away. I imagine that the stress testing, though, that the regulators in the UK will do will be far more rigorous now than it was in the past. Yeah,
I think that's right. So we should explain, as gilt yields rose, which means that their price fell, this put all sorts of stress on the financial system over there, including on the defined benefit pension schemes. It's a tongue twister, that one. They were forced to cover margin calls in some other complex instruments by selling gilts, and that sort of compounded the pressure on the British bond market. So as Tony says, this is where we're at, and there's no guarantee that pressure is going to go away with the change in Prime Minister, I wouldn't have thought. Who's going to get the job, Tony? You got a favourite?
Look, I think Sunak, the former Treasurer, is probably the ideal candidate given his credentials in economic management, and that's what the country needs at the moment.
Yeah, and Jeremy Hunt, who's the current Chancellor, who stepped in and unwound a lot of Truss's policies, he looks like he'll stay in that job to keep the market happy too. Tony, One other big story this week on a local level was the hack at Medibank. Now, obviously, we've seen the hack at Optus get headlines for the last month or so. This is another example, and it's fair to say that you aren't too impressed with the way that Medibank's handled all this.
No, well, James, I think every cyber attack is a test of crisis management, and lots of questions immediately get asked. How much information do we share? How quickly do we communicate with customers? How quickly do we bring the government agencies on board? To me, a Medibank private CEO, David Koska, he just tried to protect the brand ahead of customers by playing down the severity of the attack in several releases, and that was obviously a mistake, and we can see that from the fact there's been 3 trading halts, 3 separate statements, the first of which started with there's no evidence any consumer data was lost, and the third one which said we've lost 200 gigabytes of data and we're now negotiating with the ransomware criminals.
Yeah.
So, it sort of deteriorated pretty badly. I think the messaging that he, as CEO, wanted to get out was summed up in that headline by the analyst who went to the Monday briefing, and he said, nothing to see here.
Yeah,
well, in fact, there was a huge amount to see here. And I don't know, what do you think? Did you compare it to the Optus attack?
Yeah, well, I mean, I think I think you're right. Medibank did try and limit the damage, and I think they did that pretty successfully. I mean, people were coming from everywhere to pan Optus, including from the government. Medibank hasn't received that sort of heat. So in a way, you'd say Medibank's tactics worked. But the problem now is that what we're starting to learn about this hack is that it's a lot more serious than they let on. And so Friday morning, they've asked for another voluntary suspension of the shares. It's quite extraordinary that this company is not going to trade until sometime next week, and that we still really don't know where we're at with this hack. We don't quite know how much data has been stolen or how it's going to be used or what the implications are for customers. You know, it's not good enough. Medibank seems to be really struggling to get on top of this. So I guess, Tony, though, is there a company in Australia thinking, you know, we could be next? Everyone's got to be worried about this now, don't they? Two very high-profile hacks in the space of a month.
Look, there was a very good timely survey published by McGrath-Nicol this week, and I spoke to their cyber expert, Darren Hopkins, and he was pretty adamant that Medibank Private had handled it badly. So that survey found that I think 70% of Australian businesses surveyed had paid a ransom. So there's a definite trend there in Australia, and yet the Cyber Minister, Claire O'Neill, said that businesses should not be paying ransomware. But if you think about it, James, if you're sitting there with the opportunity to get all your data back for a payment that's, you know, relatively small compared to the damage that could be done, you'd probably agree to pay it. What do you think?
Yeah. Oh, I think you're right, but I think you're right, but I think the minister's right too. I mean, the law is really unclear in this area. It may technically be illegal to pay a ransom because you're potentially funding criminal activity or terrorist activity even. So I think the minister's got to say steady on with the ransoms, and meanwhile, clearly from this survey, lots of companies are just getting on with the pragmatic approach and shelling out to make these problems go away. So it'll be fascinating to see where it goes. But, Tony, we should turn to the other big international story of the week now, and that was the Chinese Communist Party Congress, which was essentially a week-long celebration of the rule of Xi Jinping, who's set to become the leader of China really for life after this series of ceremonies. You've had a look, Tony, at what Xi's said, and he's made some big calls on Taiwan and some sort of assertive-sounding speeches. What do you think the big lessons for Australia are?
Well, I think we've got as much at play here as all the rest of the world. Whatever he does is going to have an impact on everyone simply because of their huge proportion of global trade, their contribution to manufacturing, the fact that, you know, when you go into a shop, most things are made in China. I didn't listen to the speeches. I mean, I don't understand Chinese, but I thought the Goldman Sachs analysis of his speech that he gave, the major keywords, comparing them with previous speeches in 2017, 2012, were interesting. That there's an increased frequency of the words people, socialism, modernisation, security and military. That's all reasonably significant, whereas 5 years ago, there was much more mention of growth, law-based governance, economy, reform, innovation. So that's sort of gone off the agenda. But, did you obviously were looking for signals about property, given that you'd written a column on that?
Yeah. Well, it's fascinating that you say there was less commentary about the economy in this speech and more on sort of security and defence. Part of that might be the fact that the Chinese economy is in pretty bad shape. I mean, the property sector, which is sort of somewhere around 20-25% of GDP, is in a hole, and it's been there for 2 years. Sales are down of new homes, investment in the property sector is right down. And this is the major driver of the economy. This is also bad news for Australia too, because what do you need to make big apartment buildings? Lots of steel, which means lots of Australian iron ore. So I don't quite know how the Chinese authorities are going to get around this either. The problem they have is that COVID's still doing the rounds of China. They have crappy vaccines and poor vaccine coverage, and so they're sort of stuck in this world where they have to maintain COVID zero policies, or they face outbreaks that would turn pretty deadly pretty quickly. So, it's fascinating that as they celebrate this big moment in the sort of history of modern China, the bedrock of the economy is starting to crack. And Tony, they're also in this increasing sort of Cold War with the US over technology, which has really ramped up in the last week or so, last couple of weeks, I should say, with the US banning chip exports to China in some circumstances. Tell us a little bit about that.
Yeah, well, I've been looking at a range of different measures of tech leadership in the world, and based on the Global Innovation Index published by the World Intellectual Property Organisation, comes out every year. Always very interesting to look at where Australia stands, and we've gone backwards to number 25 behind the Kiwis.
Behind the Kiwis, gosh.
And the Chinese have gone up a notch to number 11. Now, they're still well behind the Americans, who are rated number 2 in the world for innovation. But there's a number of leading indicators in that report that show that the Chinese are catching up quickly. For the first time, there are as many top 100 science and technology clusters in China as in the United States. That's significant.
Right.
The Chinese are the world leaders in the development of standards for 6G, which is the next iteration of mobile networks, and that's going to be very powerful if they're setting all the standards for the world. That's something that will probably annoy the Americans immensely, even though all the chips inside American phones are going to have to be American. I think the fact that China has such a surveillance state, and this is, I don't know if you've heard of Su-Lin Wong, the Economist's China correspondent. She's got a very good 8-part series on Xi Jinping. But the point that she was making there in the last one I listened to was that they're going to be the leaders in artificial intelligence, because the amount of AI you need to analyse the data generated by censoring and monitoring a population of 1 billion people, it's just incredible, the resources that are being thrown into that. So I wouldn't be surprised if they lead the world in AI, and they won't be concerned with the issues that are coming up in Australia, Europe and America about the important human rights and other privacy issues and civil concerns that all flow around artificial intelligence.
They might be listening to the Chanticleer podcast right now, Tony, and not sure what intelligence they'd get out of it, artificial or otherwise. What do you make of this?
Okay, well, come on, man. This is.
What do you make of these American chip bans, though? Is that a pretty sort of short-run thing? We've seen some Chinese tech firm share prices knocked around a bit in Hong Kong in the last couple of weeks. But I mean, I guess what you're saying here is that's probably a short-term setback that China will get over in time.
Eventually, the world's best chip-making machines come out of Europe, and they're only sold to countries that are approved by them, and they're not sold to the Chinese. But I suppose it's a disintegration of the integration of the Chinese economy into other parts of the technology world. It's, to me, significant that some of the biggest manufacturers in China actually are Taiwanese. You think of Foxconn making all those Apple mobile phones. They're employing just so many Chinese people to produce goods for the global market, and that's one of those issues that makes you think any attack on Taiwan is going to be out of the question. I mean, do you have an opinion about whether the Cold War will become a hot war?
Oh, look, I probably don't know enough, but I mean, there's a fair bit of sabre rattling that Xi's done this week. I think the sort of tech issues and America's determination, I guess, to isolate China seems to be pretty strong. Biden's not backing down there, so hopefully common sense prevails and it stays sabre rattling and continues to be a sort of Cold War. I guess Taiwan's the question, though, isn't it, Tony? I mean, if we were to see an invasion, that changes the equation. We wouldn't have thought at the start of this year that we'd see an invasion in Ukraine. So it's hard to say never, but what do you reckon?
Oh, look, I don't think it makes economic sense for China to do that. And I read somewhere an analyst report this week that the low birth rate in Taiwan means that by 2049 the economy will really be struggling there, and maybe they'll actually be seeking help from China. But from an investor's point of view, the MSCI China has been one of the worst trades of the year. It's not been a good place to put your money in Chinese stocks. But in that index, 30% of the constituents are trading below their book value. 9 times earnings sounds relatively cheap for a high-growth economy relative to other parts of the world, but I'm not convinced. Are you a contrarian on investing in China, or?
Oh, I think it's so hard, isn't it? I mean, you're right. It sounds cheap, but it could get cheaper. And there's just so many things in play. It'd be hard to wade in there until we know more about this COVID zero situation, I think. I think that they're throwing so much at the economy to stimulate it, but it's until you can lift these lockdowns and get out of this pattern of regular lockdowns, it must be hard to stimulate the economy. So I'm with you. Be wary at present.
At zero COVID's going to be there till March next year, which is actually an interesting impact on Australia, because until those Chinese airlines come back into the market, that monopoly that Qantas is exploiting and its own huge profitability is really going to be under less pressure, because those big Chinese airlines were taking a lot of Australians overseas.
Yeah, no, good call. Good call. Tony, it's also been a big week for our miners, who've been busily telling the market about their September quarter production results. And one of the big stories to come out of this has been about the struggles that energy coal miners, so these are the coal miners that dig up coal for our coal-fired power stations, the struggles that these guys have had to maintain their production in the face of some very wet weather on the east coast of Australia. And of course, less production means higher prices, which means some of these miners are throwing off spectacular amounts of cash. Tony, what's driving higher coal prices? We're supposed to be in an energy transition, moving away from these coal-fired power stations. What's going on here?
Well, look, it's like so many disruptions in the world. It all gets back to the Russian invasion of Ukraine. I saw a note saying that European consumption of coal is going to rise by 15% this year. There's similar trends in Asia. Some of those old coal-fired power stations are being cranked up again, and that's what's contributing to it, that people have had to go back to the old fossil fuels because the renewable energy is not available yet, because there hasn't been the firming capacity investments made.
Yeah, and thermal coal out of Newcastle up above $400 a tonne, which is, double where it was 18 months ago. It's quite an extraordinary story.
It is, isn't it? And one of my pieces I wrote to get into this story was the deal of the year. Now,
Yes.
I might have sort of gone off a bit early here, James, because there's still a couple of months to go. But the Glencore purchased the Cerrejón mine in northern Colombia for, in effect, they paid for it out of cash that was already in the bank at that company. And, of course, the sellers were BHP and Anglo. Now, this, I believe, is the best deal of the year. It was completed in January because, having got it for virtually nothing, it will earn US $4 billion EBITDA this year. Now, that is just absolutely amazing. I think it pointed to the fact that Glencore itself might be undervalued. It's half its earnings in the half year came from coal. And BHP, by the way, Mike Henry said he had no regrets about selling that business. He didn't want to hold it and deplete down the assets. But it was probably a little premature, I would think.
Yeah, yeah. So we've got this interesting divide in coal. There's two types of coal. There's thermal coal, which is used in power generation, and then coking coal, which is used to make iron ore. So BHP's sort of drawn a line in the sand. They're happy to stay in coking coal, which is used to make iron ore. They don't want to be in thermal coal, which is the dirty side of coal, I guess people see it. So this Cerrejón mine was a thermal coal producer. And Glencore must be doing fantastically out of its Australian thermal coal mines as well, Tony. I mean, they must be minting it at the moment.
I'd say so. I was down the Hunter Valley the last weekend, James, just babysitting my grandkids, and while my son and daughter-in-law went to a wedding, and all through the weekend, you'd hear these explosions. Work's not stopping on Saturday and Sundays at the big coal mines in the Hunter Valley, and you can understand why. These big booms are going off all weekend. So, yes, I think they're trying to maximise production while they can. Just one other thing about Glencore, of course, the other signal that BHP, apart from missing the opportunity there in Colombia, is that its bid for Oz Minerals at $6 billion, probably have to be $7 billion to make it happen, puts a certain value on copper, and you can work out what it is per tonne. If you take that on a look-through basis at Glencore, then Glencore's worth about $60 billion. Its market cap's only 70. So that's just its copper holdings. They've got nickel, they've got coal, and they've got a trading business. So, I don't own any shares in Glencore, but it does seem as though these dirty these companies that own dirty assets still are not very well appreciated by the market.
Yeah, yeah. The other big news in coal, and particularly thermal coal this week, Tony, was the Victorian government effectively nationalising its or part of its electricity industry. They're going to try and get thermal coal-fired power plants out of the state by about 2035, and now they're going to have a controlling interest. The government, this is going to have a controlling interest in all new renewable projects in the state. We've seen governments intervene in energy markets, Tony, but this is next level stuff. Yeah,
this is really going back to, it's not similar to the nationalisation of the Australian banks, which proposed by the Labor Party after the Second World War. But no, this is very interesting. And of course, Daniel Andrews didn't say, when he had a crack at the energy companies for exploiting consumers and the woes of privatisation, he didn't say that these assets had to be privatised to pay for all the debts that have been blown out to kingdom come by the previous Labor government. There was a lot of mess there to be cleaned up from all those financial disasters and various things that happened under John Cain. But I think the government has really had to do this because there is no national plan. We're still waiting on the Albanese government to come up with what the firming capacity structure is, and firming capacity means having the hydro, the batteries, and other forms of energy to replace the coal-fired power. But what did you make of it? Is Daniel Andrews, is this part of an election strategy?
I think partly. I mean, I think he wanted to create a villain and a hero, and he sort of cast Labor as the hero that can reduce power prices and the power companies as the villains. So that's, there's a good bit of retail politics in there. But I think the bigger trend here is that governments are just going to intervene in these markets more. We had our energy summit last week, which we talked about on last week's episode. The national electricity market isn't working that well. There's lots of issues in it, and you can see that governments are getting impatient. They want to intervene. They want to shape where it goes. And I think these interventions are going to be seen more regularly. So get used to it. And while that happens, as we try and manage this transition, I think we'll still see some pretty healthy prices for coal. So, Tony, how do you play coal? You've talked up Glencore. Would you find a way to invest in coal, or are you sticking clear?
No, look, it doesn't meet my ESG criteria, James. But look, if they can separate those green metals businesses in Glencore away from the coal, it might get in my portfolio. But and by the way, I saw a very good analysis of ESG stocks that had done incredibly well in 2021. They're all down significantly this year. So
right.
That strategy actually hasn't worked too well either. It's a bit like my tipping of footy teams.
Yeah, well, I can see. I think the BHP view of the world's not a bad one. Coking coal, we're going to need a hell of a lot of steel for this energy transition. We don't have a way of making steel on a sort of scale level without coking coal at the moment. So there's a future for that, and we need it to deliver this energy transition. We need it for the poles and wires and the big wind turbines and the new renewable generation projects. So I think if you can stomach coal in any way, it's on that coking coal side. But Tony, let's come back after the break. You're going to take a very special trip next week, and we want to hear all about it. All right, Tony. The Chanticleer show goes on the road this week. You're taking the journey down the highway from Sydney to Canberra for the federal budget. Are you excited?
Yeah, look, it's always great to catch up with Financial Review colleagues in the Canberra office, and particularly Phil Curry, who... his political analysis is great, and we heard that. I don't know if you've listened to the podcast, The Fin, with
yes.
Phil and Lisa Murray. Really good analysis of what's going on in Canberra and where the Albanese government is at the moment. But I heard Phil say that his first budget was 97. Mine was 92. So I actually have a couple of years on him there in terms of going to the lockup, which is really just like a massive HSC exam. You're in there for 7 hours and you come out and you've got to produce the goods.
Yes. Well, I'm sure you're going to pass that exam, Tony, but is Jim Chalmers, the Treasurer, going to pass? Or anything you're particularly expecting?
Well, look, everyone goes in there looking for what will the Treasurer pull out of the hat. What is the big centrepiece item that wasn't leaked? Now, by the way, you're not allowed into the budget unless you've signed a confidentiality document that could let you end up in jail. But in the 3 weeks beforehand, the government conveniently leaks everything in the budget. So I don't know how that is rationalised. But look, I'm going to be watching for measures that create deeper engagement between the government and industry super. It's a bit like what Daniel Andrews has done in Victoria, or doing in Victoria. He wants the super funds to pay for his sort of, I suppose, nationalisation of electricity to help him get that done faster. So I think maybe that'll also be the case in Canberra. And, the industry super is part of a bigger strategic advantage, has the world's fourth largest pool of savings, more than half of which now goes offshore. Should it be spent here, and can we get the government to work more closely with the super fund members?
Yeah, good question. Now, Stage 3 tax cuts have been a big talking point in the lead up to this. Chalmers sort of, some days he seems to say they're going to go ahead, and other days he flags how much they're extra they're going to cost and seems to be ready to scrap them. Where do you think we land? Do they ultimately go ahead?
Look, I think this is probably a two-term government, so he's got time to actually go to an next election and say, do you want them or not? And probably the government doesn't want them. But to be honest, James, it still leaves this problem of bracket creep. If you can't have a flat tax rate for those people who are aspirational and want to earn $200,000 a year and have the same rate of tax as they had on 100,000, then you're just going to have every year people paying more tax for actually not any additional sort of incentive for higher work and productivity.
Yeah. I think there might be a pragmatic middle ground. Perhaps there's a way of retaining the cuts but reducing them in some way that sort of pleases everybody and nobody and kills off the issue. I don't know. Let's wait and see. It's also a big week for our banks next week, Tony. We have bank profit season starting. ANZ on Thursday and Macquarie on Friday. These numbers should look pretty good, shouldn't they, Tony? Because the banks are getting a tailwind from interest rates. Everyone's still spending, still plenty of mortgages around. Might look very different in 12 months' time, but it should look okay next week.
Yeah, I think so. I mean, it's like you wrote about your analysis of the US banks. It's the ones that are just doing investment banking that have suffered, and those that have got a big retail base and can, I don't want to use the word screw them, but I have. You basically don't pay as much on the deposits as you charge on the interest. But what are you looking forward to talking to Shane Elliott and sort of finding out his view on the world?
Oh, absolutely. I mean, I think it's going to be fascinating to see where these banks think things are going. We're all waiting, including the Reserve Bank. We're all waiting for these interest rate rises to bite. But it's just not happening. The banks are reporting that consumers are still spending. Their mortgage competition's intense. So I want to see the next bit of evidence. I want to see if there's any movement at the station. Is the economy starting to slow at all? And I'm hoping Shane Elliott can help us on Thursday.
Yes, well, let's see what Shamara says on Friday. She's a person who's in great demand and often has a very insightful analysis based on what's happening across funds management, financial markets, energy trading. There's a lot going on in that institution.
Yeah, Shamara Wickranamayaka is the CEO of Macquarie, of course, and hugely respected, not just in Australia, but around the world. All right, Tony. Well, we're loving the questions we're getting from our audience. Please keep them coming. Send them to chanticleer@afr.com and we'll do our best to answer them. Today's comes from John Cale from Sydney, who asks about the 50% capital gains tax concession. Should the federal government leave the 50% CGT concession as it is, reduce it to 25%, or remove it completely? I looked at some Grattan Institute modelling before, Tony. That they advocate reducing it to 25%. They reckon that wouldn't hurt the property market and would save the budget plenty. Is that the middle ground?
Yeah, it probably is, James. Whenever the topic comes up, there's always those people who say that there'll be all these deleterious impacts. But I like the radical idea that people like myself, the baby boomers, start to pay a bit more. I mean, imagine what impact there'd be on housing affordability if there was a capital gains tax on the family home. Now, I know this is viewed by many as an outrageous idea.
Tony, gosh, sacrilegious.
But this is something that really, when you see all those harbourside mansions being traded tax-free as their family home at 20, 30, 40, 50 million, it's a very strong argument for either a higher capital gain, a capital gain tax on homes, or, as Paul Keating and Dominic Perrottet have been saying this week, a land tax that is there permanently and can be enforced so that those incredibly wealthy areas are actually paying a share of taxes that are equivalent to their wealth.
Yeah. Well, I'd encourage landlords and property owners to email Tony at chanticleer@afr.com and see what they think about his radical suggestions for home ownership there. Tony, it's been great. Travel safe to Canberra, and we look forward to getting all your insights from Budget Week next week on the podcast.
Thanks, James, and have a good week.
If you like the podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Apple or Spotify or wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thomson, and Tony Boyd. And it was produced and edited by Lap Fan and Alex Gow. The executive producer is Fiona Buffini.
The Australian Financial Review.